Hello, Warriors. How's everyone doing? Alexander, Ingmar, hello, Hugo, hello, Oliver. Let's take a look around here. Yields are trying to stabilize. Hello, Ryan. NASDAQ under pressure. So, US dollar yen is up. Do we have one more shot down? 10-year yields say it's a possibility. Here's your yield chart. You got a 1 and a 2. Could we be heading back down? Yen never really got to its targets down and under the 108 handle. So that could be a shot. That could be a short. They're getting to the gold with stronger yen. Gold's for the first time in many days weaker than the silver. Silver's up 10. Still looks ugly to me. And getting I think just a bear market rally in WTI. I think the back has been broken. I know a lot of people wanted to buy it at $70. Uh, maybe we get a rally back there. I'm not sure this is the low. Perhaps we're going to, see a 5 handle on it. $57 looks doable. Okay, and we have ECB today, I believe. So Ryan, how are things across the pond? What are we
Hi,
looking
Dale.
at there?
ECB tomorrow, mate.
Oh, okay. Well, then I've
Got an
given
extra
people
day to think about it.
a lot of time. Yeah, a lot of time to prep for it. Any other features that you see over there today?
No, it's fairly quiet this morning, as you mentioned, with yields. US yields, you're looking at tens. They're sort of looking to stabilise a bit. I think a bit of the market's in what next mode. We were here yesterday. The day before, we had a yield drop off, then a bounce. Yesterday, yield drop off, then a bounce.
Okay.
So I think we're actually going to be waiting for you guys in the States to come in and set your stalls out. But fairly quiet, euro dollar, 30 pip range odd.
For a long time
cable,
now. I mean, look
yeah,
out.
cable the same.
Yeah.
Dollar yen, as you said, has crept up. Is sort of trying to hold above 110, but it's one of these times where you think, you don't want to think, this is solid. These moves are solid because in 10 minutes time it turns around and the poo's hitting the fan again.
Yeah, and just one thing I want to point out that yesterday's big rip that we had in equities after Monday's fall did stop at the 61.8 level in NASDAQ, got through it a bit, almost got to 78.6 in S&Ps. So still a possibility we have a failing rally here. So just wanted to point those two things out. Any feel on Euro Pound? We're getting a little bit of a pop from last week's lows. Do you have a bias in there, Ryan?
Yeah, I'm short this pair. I've been short since up near 92 late last year on a bit of a Brexit play that I wanted to roll into this year on a virus recovery play. I've been waiting. My big level's down at 85, 84.80. Right. You can see that prior low down there in April. Yeah. The key level is down at 85, 30, 50. It's been a really sticky area as you got marked there by one of your fib lines.
Yeah.
Prior to that, the last couple of weeks, I've just been playing shorts off of 86 and letting them out, as I said yesterday, sort of around about 85, 80 and wherever it goes. This break above 86, 20, 30, that looks to be key at the moment. If we hold above there, we may get a push up to 87s. Again, you can see that on your chart, those series of highs through April, May. That's the area I'm looking at as a potential top.
You think there's at least one buy stop here above these highs?
Yeah, I think so. It's not it's not huge level. When we were trading it around then, it was mainly sort of an intraday level. But time's gone on, and when you've been away from a level quite a while, they can firm up a bit more. And as you say, people start parking stops above it because it could kick up another leg, and we head towards 88. But in the on the wider view, it's the bigger range here, sort of 85 all the way up to sort of 90s, 93s. That's the massive range. But I'm still happy to get in shorts and hold shorts, and I'll be looking around that 87 zone for sort of short-term trades and to potentially fold it into the core short as well.
Okay, here's some pretty good confluence up here at 88 as well. So
Yeah.
appreciate that. Thanks for your update from London. Are you in London, Brian?
No, I used to be. I moved to the south coast a couple of years ago. Get some
Nice. What's the weather like there? Do you get winters? South coast of
we get winters from about September to about September.
All right, Ryan. Thanks very much. And
hey, Ryan, thanks for stepping in this morning. How are you guys doing?
Okay. How are you, Blake?
I'm great. Just tuning in, and I missed everything that you said. But let me just sum it up for me, Ryan. How are you feeling about the euro sterling right now?
Yeah, just as I was saying to the guys, should make you watch the replay, really, shouldn't we?
Yeah, you really should. I mean, I know I popped in off of another meeting, so you had to excuse me. So
yeah, no, I was just briefly. I'm saying that the next real level for me is up towards 87.20.
Yeah,
we're in a bit of a range here between there and my big level below, which is down around 85, 84.80. So a bit, bit of intraday play here around the 80, 86, 30, 40 area, maybe down to 20s as well, and see what happens either side.
I love the fact that, over, let's just call it, over 2021, we didn't make a new low. And so we're actually making higher lows. So technically, it's trying to turn the tide a little bit of this, bearish euro pound move that we've seen, coming off of 2000, end of 2020 into 2021. So, that scares me a little bit, because me personally, I've been more of a sterling bull over the last, you could call it the last 12 months or so. But I expected more out of the move of the pound, given the fact that the cable couldn't, really get a foothold above 140. I'm sure it probably concerns a lot of longs, especially maybe some institutional longer term money that has been, has plowed into the UK and plowed into to sterling or cable longs. How do you feel about the sterling up, here, especially now that we're trading below the 200-day moving average?
Yeah, I mean, it's one of those questions. How far do I go back? I was bullish on the pound all through Brexit. I knew a deal would come.
Sure.
In whatever shape or form. Obviously, during that time, there's plenty of ups and downs in it. It's just picking your moments, around those certain deadlines, things like that. But I always wanted to be long the pound into the end of Brexit, and I did that via euro sterling, because for me, it's the better play. Plus, also, as I mentioned earlier, I was looking to run that into the potential virus recovery in the UK, because we had the vaccine advantage. We were way ahead. That was going to play into the economic sides, the fundamental sides, but also to keep it with a few of the central banks, because the BEE is likely to move much faster than the ECB. The ECB may be one of the last to move. It's going to drag its feet as it did after the GFC, and so then I'm trying to keep a long pound bias through all these different events: Brexit, the virus, potential central bank action, and so that's my bullish stance. But as you say, you've got to. When I trade things like that, I really look at the big, wider levels, and if we get a move to the extreme edges, then I'm in. But it's been a solid move all the way down from those strong tops in around about the 93s, 92s.
Yeah.
So not going to complain if we're 8, 9, 1,000 pips lower than those. But I make you right, that 85 handle and down there, that's the key for me. If we crack that properly, then we're off to the races.
Yeah. All right, on. Well, hey, just really quick while we've got you here, and I want to get your opinion on, because I might have missed it, but how do you feel about risk appetite here? As far as like equities go, we had a nice sell off in equities earlier in the week. On Monday. Tuesday, we had a nice little turnaround, nice little bounce back. It kind of seems like we're mid-range. We're still holding up a fairly bullish tone here. A lot of talk about the Delta variant, and I think if everybody just takes a step back, like we said on Monday, it's COVID, and it's a Delta variant. Until deaths actually start going higher, I don't know how much of a impact it's really going to have. We're really holding up fairly well in the equity markets, but do you feel that we might be a little toppy? And if we are, and we start to sell off, does the dollar catch a risk off bid? What do you think, right? Where we're at right now in the state of the market?
Yeah, I mean, to be honest, things are quite crazy in terms of your normal market fundamentals. What gets defined as risk these days, and what doesn't. I was looking at this morning. We had a rally in bond yields, and we're seeing the yen react. We're seeing the yen sold off. But then you look at cable and the euro, and they're hitting session lows. Then that yield continues, and the yen pairs carry on rising, and all of a sudden, cable and euro turn around, and they're now heading towards highs and making highs. And you think, is this risk on? Is this not? Is it against the dollar? Is it against yields? Is it against the yen? And if I'm honest, sometimes I don't know what's risk on and risk off these days. 2 years ago, you could name it. Risk on was stocks up, and you'd see gold move and yen move and yields move. But when you're watching intraday and watching every single moment of every single day, you get these little differences, and you think, well, that doesn't fit the bill. But what do? We do what we do best, and we look at the charts and we pick our levels, and we add all the different things in together. Is oil moving? Is the commodities moving? Are stocks moving? And you just try and piece together what's driving that particular move, and you get in that zone, and then you can apply that to your FX trades and know which side you're best to be leaning on. But in terms of risk overall, it looks better today. Is it going to last? That's the question. We've come off 2 days of it looks better. Oh crap, it's gone again. Is today going to be the same, or is it going to be different? And the only way we can do that is watch the levels, and if the resistance levels start breaking in some pairs or the support in others, you go with it, and you see where it takes you.
Yeah, and it's interesting. I was talking to one of, as you guys know, those of you at home, and if you're not aware, Ryan and his team has joined, the Forex analytics community, and just show you really quick. Here, just so you guys can see our chat rooms that we have, our trades room where where we place our trades. We have our general chat where there's a lot going on. I was having a conversation with one of the new traders, and new for us, but one of Ryan's traders, Steve, and we were talking yesterday, and he's been on Trade Desk for 30 years. And it's interesting. We were both having this conversation about, it almost seems like at this point, after 30 years for him and 25 years for me, what we've learned in the past doesn't really apply. And I think that's really true for a lot of markets right now, because we are the market is at a place kind of like if you take the late 90s and I know I go back and reference this every once in a while, but the .com bubble, if you will, when markets are so exaggerated and markets are so one way, it starts to blur the lines on what's important and what's not important. I think all will come back into alignment at some point. When we've come off of a major high in equities with central bank stimulus, excess liquidity, rates at zero bound. But once rates start to move and you start to see a shift in rate expectations, liquidity start to come out of the markets, I think you're going to see these correlations that were once really important in the markets. They're going to be important moving forward. What do you think about that, Ryan?
Yeah, no, I agree wholeheartedly. And this is a conversation that we had in our room time and time again. The market almost has a goldfish mentality these days. It can't hold a theme for more than 5 minutes. As soon as something changes it or spooks it, boom, we go the other way.
Yeah.
But that's the nature of markets these days. I mean, we look at the whole virus situation. We had a blowout for what, 2-3 weeks in the last year. When the virus first hit, markets crapped out for 2-3 weeks. That was it.
I know.
Everyone
Yeah.
thought panic. Central banks, started cracking open the emergency boxes and chucking everything at it. And, while people were going to be worried about banks and whatever. And it was like, there's no banking crisis. You've already sorted that out in the last 10 years. This is a health crisis. But it's that speed at which everyone went, oh, crap, this virus is bad. But in the market terms, it went, oh, after 2 weeks, 3 weeks, oh, actually, well, we've got it covered. And then obviously from there on, we're looking at the vaccines and how it's going to affect economies and the lockdowns and all that sort of stuff. But there is an element of goldfish thinking in the markets where ideas and thoughts can change in an instant. 1 minute you're trading one way and next minute you're 20 pips offside and you think, what the hell happened there?
Yeah. So it's gonna be really interesting, Ryan, moving forward. I think we're gonna have to pay really close attention to what's happening, and I think the stock market's actually gonna tell us and kind of cue us in. And to be honest, I think Monday's lows, if you ask me, Monday's lows in the S&P are and will be, and you can see this red line right here is basically it, because this is where I really want to be notified. That's what I call the line in the sand in the market. Above this week's lows, you have to continue to stay bullish, constructive, and risk. But we start getting below that, and I think we're going to be seeing a little bit of a shift in the markets. And you're seeing even emerging market currencies like the Mexican peso underperforming today, and it did it all day yesterday. And I think these are the cracks below the surface. If you start to see these EM currencies like the peso, you see the ZAR, you see the ruble, you see them really start to roll over a little bit, and you start to see the dollar pick up against those. I think you gotta start, putting up the antenna for possible risk off. So, hey, Ryan, thanks so much for your comments this morning. We love having you in the community. It's been a lot of fun. Obviously, the last few days have been a bit of a whirlwind for all of us, trying to see how the dust settles. But our chat rooms are very vibrant and very active, and I'm enjoying all the new traders that you're seeing in here. It's really, really nice to see.
Yeah, thanks, Blake. And as I say, pleasure to be here.
All right. And let's bring on, and Dale, we got to talk to Stelios and Steve, see how they're doing this morning.
Yeah, bring them on. Hi, Stel, Steve.
Good morning.
Hello. Thank you, Ryan.
Hello,
Good
everybody.
morning, guys. So anything that you guys see over there that you want to talk about in this quiet environment, day before ECB? It's probably quietest, tightest range trading I've seen in a while in the euro.
And I wanted to say, Dale, I really wasn't, before Steve and Stelios say something, when I came on the week ahead video on Sunday, I referenced this wedge. Go back and listen to the Sunday video. I said, hey, we're building a wedge in the euro. And I said, I did not think, and I'll say it again, I did not think that I referenced the wedge, but I'm like, I don't know if that's going to be able to hold us through the ECB, especially, with some volatility picking up in the markets. We saw some volatility pick up, and guess what? This euro has been really confined to the wedge, and that's surprising to me. And I think, you hit it. We're waiting for the ECB tomorrow. So, Stelios, Steve, what do you guys think about this, the FX market going into the ECB, and what should we expect?
Well, the euro is going to be, like you said, I think it's going to be tight going into the ECB. The question is, what can they give us that's going to unsettle the markets either way? And it's difficult to say. I think the ECB it's difficult to see them being hawkish, with everything that's happening, with all these, the Delta variant and this and that. Every central bank has almost a duty to be more dovish than they should be. So I don't see how they're going to be surprised on the hawkish side. Could they surprise on the dovish side? Yeah, they could. But I think unfortunately currencies are the euro going into the ECB is going to be quiet. Equities though, remember what I've been saying for the past weeks. As long as yields are low, I don't think we're going to see any sustainable move lower. Look at the S&P, just completely reversed. If you look at the daily candles, just completely reversed that catastrophic 2% drop. Oh my God, it was the end of the world. Well, here we go. So I'm not saying buy up here because it's very difficult to get long at these levels, and valuations and all that. We all know its valuations are very high and we should correct at some point. But I'm just saying it's impossible for me, at least, to step in front of this thing. I need to see a proper move. I want to see yields going higher, and I don't care if I miss the first 5 or 10%. I want to catch the rest of the move. So unless we see yields higher and a proper technical event, I don't think we should be selling stocks. End of story.
Yeah. Okay. And Steve, how do you feel about that? Is it a yield story, or I know you. Well, I'll let you finish. I'll let you talk. How do you feel about where we're at currently with equities?
I think that not much has changed. We saw a decent down day, but as I said, when that happened, we've seen a lot of them with no follow through during the past year, right?
Yeah.
And unless I see some technical development, like for example the breakdown of this wedge, I completely refrain after what we've seen, during the past 15 months from getting overly enthusiastic about the downside. So yeah, it makes sense that we've stalled ahead of the ECB. It makes sense that once again the market is hoping and expecting for more dovish gas on the fire, and the ECB might as well deliver that, right? We just very recently saw them follow with some delay the Fed by shifting the goalposts having to do with their inflation target. So yeah, there is definitely the willingness to be dovish. Now, what I believe can happen, post event, of course, I don't want to guess what central banks will say. I don't even want to try to guess what the reaction is going to be, because sometimes lately you've been seeing reactions that you wouldn't be expecting if even they told you, what had been announced or what had been said prior to that. But I'm monitoring the same wedge you are. In general, I remain of the opinion that this move lower in the euro is corrective in nature. So I don't know if it's going to end here or it needs to move somewhat lower from where we are before it ends. But for me, the path of least resistance in the medium to long term remains higher. So that's where I'm looking towards. But of course, I want to see some confirmation that we've bottomed out first, and we don't have that yet.
All right. Well, I appreciate your thoughts on the markets. Dale.
Yes, sir.
What's your opinion on the markets where we're at?
Well, I'll tell you something that I saw. If you pull up the notes or the bonds, and
let's go take a look at the 10-year.
Yeah. So
because I did miss your comment. Usually I hear your comments every morning. As I tune in, I just missed the first 5 minutes due to a meeting. So here's the 10-year. Is that what you're looking at?
I was looking at TLT, put in a real big reversal day. It's a 20-year ETF, TLT, and I think that might be the end of yields falling for a while. Put in that nice little reversal day. I wouldn't be surprised if we got to levels that Stel was looking for in the Bunds. I think yesterday was a pretty negative day. Yen seems firm, gold down, so this may have ended the correction in bonds up here.
Well, that you bring that up, and I don't know where here it is. Let me see if I can bring the DSI up for you. This is from is yesterday's daily sentiment index. If you look at the previous day, it was at 91. Yesterday it was at 85. So we were at that extremes, and we had talked about in the chat room. Look, you got to be careful of the bond market pulling back and yields bouncing yesterday, and that they did, and it pulled that dollar yen up. So, and that really comes through, and you can see it in this chart in the TLT. Now, does that mean that yields are going to continue to bounce?
Yeah.
I think if
Yeah.
they are, Dale,
Could
then
be.
that's going to coincide with a stronger equity markets. Would you think?
Well, they say it's negative for growth stocks. So, I mean, there's so much, rotation going on that,
Yeah.
people have been selling, like the Russell is still pretty weak, still hasn't made a new high.
Yeah,
And
Dale,
the high,
but
Go
we
ahead.
have to put that in context, right? Meaning, currently, just by reported numbers, reported inflation, and where nominal yields are, we are at, deep well negative real rate territory. I mean, literally, we're talking about real rates that are roughly minus 4%. What I'm trying to say here is that, in all honesty, it makes very little difference to growth stocks or to whatever other instrument if real yields are -4, -375, -350, or -4.25. Right? I mean, it's like a drop in the ocean.
Okay.
Well, I would agree with that. But hey, Steve, real quick, and guys, I just want to reference that with tomorrow's really the ECB, because we just have a few minutes. I actually just looked up. I looked at the clock and I'm like, oh my gosh, we're almost finished here. With tomorrow's ECB meeting, I know that the euro may be kind of quiet, but I don't know if the FX market is going to be quiet in general. And one of the things that we have coming up today is we have crude oil inventories that are coming up in about 2 hours time. We should pay attention to them because crude, and I want to bring this up. I'm bringing this up for a reason because let me pull up crude oil wherever it was just at. Yeah, right. Where's my WTI? Where did it disappear to? Oh, there it is. Okay. Crude really found very key support here around the $66 a barrel. You can see we had this previous trend line. We knew it was going to bounce from there. It bounced. You can go back and look at Forex Analytics the last few days. So let's go over to crude finding support. And then, bouncing off of the trend line, but now that it's bounced off of that trend line, we know where it's bullish and where it turns bearish, right? So knowing that, as long as we're above $66 a barrel or so, roughly about $65.50, $66, it's bullish. But with crude oil inventories today, how about if we take out that number, and crude starts to fall? You got to look at currencies like the dollar Canadian. That is, in my opinion, we talked about this yesterday. Looks like that we're just flagging here, like a bull flag formation. You have the US dollar, Norwegian krona, after having a really strong squeeze. Looks like we're flagging as well. And these two particular currencies are going to act a little bit better in a risk-off environment. And that's something that I want to bring up. Even though the euro might be quiet, we have other currencies that might be on the move going into later today. So Stelios, Steve, any other last comments before Dale takes his interview here?
I think we should mention cryptos, which are bouncing hard.
They are.
And, so Bitcoin bounced hard from the 30,000 level, together with the general risk on from yesterday. So they seem to be recovering, but Bitcoin is still close enough to that 30,000-ish level to not have escaped, let's say, yet. But it's looking good today, though.
It is for now, but let's you take the high. This is just from June 15th. We have a trend line that's really capped us, for the last, what is this? Literally last 2 months or a month and a half, excuse me, or 5 weeks. we've really, been capped by that trend line. Bounces are pretty, shallow. I know today we're up pretty good, but I would argue that we're probably developing more of a wedge here. So it'll be interesting. I guess if Bitcoin can get above like 32.5, 33,000, we might get a continued recovery. Glad you brought that up, Stelios. Steve, Stelios, and Ryan, if you're still listening in, thank you so much for all of your comments this morning. Dale, have a great interview.
My guest
Thank you,
isn't here
mate.
yet.
Hey, see you, Ryan.
See you,
Bye,
Ryan.
Ryan.
Thomas Mellon, are you in the house? I've been communicating with you on Twitter. Are you there?
And
Go ahead, Blake.
I was going to say, while you guys are mentioning that, remember, make sure you visit our webinar sponsors. The reason why Forex Analytics can offer these free webinars to you guys is because of Pepperstone Securities and also Forest Park FX. So please visit our webinar sponsors, and especially for, if you're looking for a new broker, if you're looking to expand your reach globally, check them out. All right, Dale, it's all yours.
All right, thank you.
So, Dale, we have our regular Finnish guest, Tuomas.
Yeah, and he's not in the house. He still thought it was the old time. I thought I had him on, but I told him it was this time. So maybe he's having trouble.
I see that he's retweeted.
Yeah, that's what I mean.
21 minutes ago.
Yeah.
So he's definitely aware of it. I mean.
Yeah.
Okay. Have you managed to reach him and make?
No, he's saying in 10 minutes.
He answered back and he said he's going to join us in 10 minutes.
Yeah.
Okay. Then we have 10 minutes.
Okay.
to talk about stuff. Okay. I guess that's not going to be that hard, right?
Sure.
Stelio, are you still here? No, I guess he isn't. Okay, so let me share the screen and see what we can talk about. So, Blake already mentioned about the wedge. It's not a surprise, of course, that we have the exact opposite type of wedge in the DXY, right? Testing resistance yesterday, testing resistance today. Now, RSI is divergence, but I really wouldn't be surprised I'm not convinced that this wedge is breaking to the downside, because I don't think it's like that much inclined for it to be necessarily a terminal type of wedge. So I do think there is a possibility that we're going to see a breakout to the upside and a final move towards 94.50 to 95 before we see a reversal lower. Of course, the jury is still out and the DXY is testing resistance, and I don't think that we're going to get anything conclusive happening prior to the ECB. Now, it's not also necessarily the case that post ECB we're going to have the momentum to do it, but I think it's very, very unlikely that anything is going to happen pre ECB. Now, a currency pair I'm definitely monitoring is the Aussie, and the reason is clearly technical here, because the Aussie has been testing the trend line support of this descending channel that I've been watching for quite some time now. I still strongly believe that this is a corrective pullback that we have in the Aussie, which is a good representative of commodity currencies. I mean, the Aussie has always been more or less in the forefront of the commodity currencies. It's also like a developed economy currency, so close ties with China, so on and so forth. So it's like an important currency, despite the size of the country and the amount of the transactions in the FX market not being that huge, but still quite an important currency. And it's interesting that we've spent the last 2 days testing this confluence of supports, with the most important support being, as I said, the channel trend line support, and we're holding. So, for me, this is quite an important instrument, and that's why I pay so much attention to it. There is the equivalent channel in the Kiwi, but we're nowhere close to support at the moment. So, that's why my focus is mostly on the Aussie, and I think it might give us a general direction for the rest of the commodity currencies. Now, Blake mentioned crude oil, and besides crude oil, I wanted to make a mention to natural gas. So to begin with, crude oil is attempting, of course, it's extremely early on the day, right? So, you have to put that into perspective. But crude is attempting into building some kind of a morning star formation here after a very, very sharp move lower, which sliced through this corrective channels trend line support. I always use these type of channels because they give you an immediate feedback of what type of a pullback you're seeing. As long as the pullback remains contained within it, it's something orderly, it's something probably corrective, and it might be a type of a move that's going to unfold more in time than in price. In the case of crude, we sliced through it with that huge down day with which we started with the week. But as I said, we're trying to stabilize by putting a morning star formation here. Key level for me is 69.50. As long as we trade below 69.50, I think we can see more weakness in what has been, in any case, an amazing uptrend from like 11, because this is the continuous. So the continuous never went to negative territory. It's not the futures contract. That was an amazing run from 11 to 77, right? We literally multiplied 7 times in a period of, what was it, like 15 months, roughly. Yes. A proper corrective move lower can really be much deeper than we've already seen. And momentum, the one we saw on Monday, is promising, as long as I said before, we hold below 69.5. As long as we hold below 69.5, I think we can see another push lower towards $63. And the crude oil market has multiple importance for many different reasons. First of all, directly and indirectly, it's an important component of the CPI, and for a very good reason. The CPI is in the forefront of the focus of economic data at the moment, so that's something to consider, right? And as I said, not only directly but indirectly, don't forget that energy is more or less an important input for the vast majority of businesses, right? So keep that in mind. Now, on the other hand, natural gas couldn't care less, right? Natural gas, in all actuality, is breaking higher, and in my opinion, is headed north of $4 next. It's not a surprise. We know that natural gas can literally be moving in the opposite direction of crude oil. It has done multiple times in the past, and this is not going to be the first or the last time that's going to be doing so. So I think these are two important markets. Now, of course, as long as crude oil remains in the defensive, and if this is something that's going to still keep unfolding, I know that a lot of people are focusing on USD CAD and USD NOK that have, produced decent corrective moves to the massive downtrends, they prior to that developed. But I do think that it is very likely that these don't necessarily have much more to go. Of course, if crude oil remains in the defensive, that's going to help them perhaps, correct even further. But I don't necessarily think that there is much more to it. Dale, any news from your guest, by the way?
He said 10 minutes. I still do not see him in the room. Thomas, Are you there? Not yet.
Okay, no problem. Now, precious metals, since I know that a lot of people love to talk about precious metals, I'm extremely bullish precious metals, but as I've been saying for a few weeks now, I'm not bullish in the short term, right? I don't try to trade based on what I know to be fundamentally right. I try to trade based on what the charts tell me and what the vast majority of market participants perceive as the reality, because I don't care to be eventually right but losing money. I'd rather be joining the people that are wrong and making money, right? So I'm trying to separate my fundamental thesis with my trading thesis, since they have a totally different time horizon, right? So in the short term, I see no reason why not to be bearish. I see gold breaking through this ascending wedge. I see silver that once again moved first and broke through this bear flag. And I do think there is more room. There is room for more downside before we find the bottom and explode higher, because I do think that both of these monetary metals are going to be exploding higher. I mean, in all honesty, there is really no alternative considering what's happening with the monetary and fiscal madness that's been going out almost globally, at least, having to do with the developed world and not only. Ben says natural gas targets 5, then 10, then 2005 highs. Really, not unlikely, but I like to take it, one target at a time. I do agree with you. I do see a bigger bullish pattern and a big bottoming pattern that has been taking place here in natural gas. So I'm in agreement with you. And I do think we're very bullish. We broke through this big symmetrical triangle. We created a smaller one. We've been breaking through it. So yeah, I think natural gas is very bullish. Now, thinking so far ahead to say that it's going to be going to $10 when we're currently trading at 390, I don't really care to do that. We might as well go there, and anything that has intrinsic value and is priced in fiat money, especially the dollar, I'm very bullish at, medium to long term, right? But I don't think it's helpful for any type of audience if I start giving like long-term targets for like gold, silver, natural gas, crude oil, or whatever. Although I've done that on occasion. I mean, I've said a long time ago when we're trading much lower than we currently are that I do believe that crude oil is headed north of $100 within the next few years once again, when people really thought that crude oil will have like huge problems ever finding levels above 50.
Okay, Thomas is here now, Steve.
Thomas is here. Okay, good.
Yep.
Enjoy the interview.
Thank you, buddy. Nice review. People miss that. And if you miss that, you have to be part of the Morning Edge, which will start in half an hour.
Yeah, even if you become a light subscriber, you have access to all our webinars, and I go over everything.
Market banter.
Plus answer all questions during the Morning Edge, which starts in 33 minutes from now. Enjoy.
Okay, thank you. Hello, Thomas. How are you?
Hi. Yeah, I'm fine, thank you. My apologies. I don't understand how that happened, but yeah, I had
It's okay. Time. It's all right. You get used to something being one way for a while, and even after it changes, it's our default position. So, you're going to share the screen, bro?
Yeah. Okay. I'm going to share the screen. Okay. I think I would talk on the where I put it now. Just give me a second.
So just a quick update. Any problems manifesting in Italian banks that you thought were going to happen for a while?
No, they are still managing through, which has been very surprising to us actually. So this is a call we have been definitely wrong on the. We don't really understand how it happened. How did they manage to pull through all this? But they have done it.
Plus, that vote went the other way. That vote, I think it was in your country.
Yeah. Okay. It was a margin of 7 votes. So, and I can tell you that if the vote would have been cast 2 weeks earlier, the Finland would have rejected the fund. So it was extremely close. So that's like a that was a big fight here, and the thing is that what is the I don't remember the English name of the committee, but basically the parliament decided on the decision that this is the fund is one-off. It does not include any extension of the fund or making it permanent. So now when France and Germany, or probably looks like France has already made it clear that it will propose of making the fund permanent. And
Okay.
if that happens, Finland will have to vote again. And in that case, I'm highly skeptical whether it goes through here, because it was a margin of 7 votes in a 200-member parliament. So it was a close call.
Okay. So you want to address the repo market?
Yeah, this is something I wrote just I published about 2 hours 46 minutes ago, actually. So this is something that is I don't think talked enough. We've been following the problems in the repo market since September 2019, and the thing which is going on now is essentially this. So I don't know, many of you probably have heard or have not heard that this is the Federal Reserve offers a reverse repo facility where if you have excess cash, you can lend it to the Fed for one night. And as you can see, this is now at the very high level, running at $800 billion per day. And it reads $1 trillion on the turn of June and July. So this is massive usage. And as you can see, it has been very flat for very, very long. And it's actually, if you would continue this graph, there has been some usage in 2014, 2015, but otherwise it's usually flat. So,
okay. So is this what they used to call match sales?
Match sales?
Matched.
Hatched.
MATCHED, match sales, reverse repos, where they're draining reserves. The Fed is draining.
This is draining liquidity, actually.
Yeah, that's what it, okay.
Yeah.
They used to call it match sales. Yeah.
Yeah, match sales. Yeah, that's an older term, and I'm actually not familiar with it. But
okay,
this is not this is not actually doing of the Fed.
Okay.
This is banks putting their money there and other financial institutions. So this is not something Fed is actively trying to do. And this is a rather worrying development which went mostly unnoticed. It's just, in the financial media just before the Wall Street Journal interviewed Zoltan Botstar, who is a repo specialist in Credit Suisse, about it was early July, and Zoltan basically explained that there are some bigger issues, and he actually forecasted that the usage will increase quite heavily during reaching close to 2 trillion at the end of August, which would be a massive number.
Is this because there's no loan demand and the banks can't have all this cash on their balance sheet, so they have to move it. They have to move it off.
This is
a regulation thing, right?
This is how it goes. Like the basic function of quantitative easing is that when the Fed buys through the primary dealers, it creates, as it gets the treasury or whatever bond it buys, the one who sells it gets either reserves or deposits or cash, and it depends on who the Fed or the primary dealers buy the treasuries. If it's a non-bank like household, hedge fund, monetary fund, it increases deposits or cash in the banking system. And this is what we can see in the graph here. So if you look at the cash in commercial banks, it was rather stable for very long, and then the QE started. And if you see every time the QE asset is in green, every time there has been an increase or the QE has been running, there's been a massive increases in the cash reserves. And when there has been a QT, or the central bank the Fed has been diminishing the balance sheet, it has fallen. And then there's this massive peak. Sorry about that. Then there's this massive peak, which is the corona bailout here, during which the balance sheet of the Fed grew by whopping $3 trillion, doubling almost in 3 months. And it's shown here. And after the cash balances have been pushing heavily higher. And this is, we were the first to argue that this is actually the reason for all the reverse repo stuff, because banks are now flooded with cash and deposits, and they cannot push it out anymore. So the thing, basically how banks have responded to this flow of deposits and reserves in the system is that they have tried to increase lending, and especially riskier lending, because reserves which have been pushed in their balance sheet is they yield very low return. So they have been trying to counterbalance this by issuing riskier loans.
And I heard that I saw a stat that loan demand is contracting.
Yeah, and it's coming here. So this is loans and leases in bank credit. And as you can see, this has been like after a normal recession, like if you look at the 2002 recession here, you notice that, you know, the loan demand or the loans usually grow rather steadily after financial crisis. It's rather obvious that there is because there's a problem with the banking system, you know, the lending contracts. And then it grows again here, and then something happens during the Corona bailout and the shortest recession in U.S. history between February and April 2020. So there's a spike in the lending, and then it is contracting. And this is like the big issue here. So if banks are not lending, it effectively means that all that is stopping the US from entering into a recession is the stimulus from the Biden administration, basically.
Okay,
There's
so the
nothing
monetary grease to keep the economy wheels going isn't working. So
Yeah.
fiscal stimulus is the only thing left. So if there's a problem with getting an infrastructure bill through, that could be a market disappointment.
Yeah, for example. Yeah.
Okay.
And this
All
is this is quite a big issue. You know, the US is closing in on a recession, and moreover, the thing is that if you look at the gross domestic investments, they have actually plateaued already here. So this is not a big thing, but still they seem to have stopped the growth. So, you know, there is some indications that this is already happening, if you look at this.
Okay.
And yeah. So, but there is another thing. If you consider what this means, is that the banks and the financial institutions have parked about like 800 to 900 billion of the cash, the liquidity the Fed has been pushing into the financial markets. So they are doing this every night. And if you look at this graph, it means that basically this whole growth in a year has been pushed away from the market. So this is actually quantitative tightening already.
Was there a rate that was moved up from 0.0
Yeah.
to
In a-
0.05?
Yep, in around it was in around, let me see, it was in the mid June, so about here. But the thing is that they had already grown quite heavily, and it made the thing worse. So this is the spike after the rate hike.
Okay. And no one really knows, no one talks about it anyway.
Yeah,
That-
no,
that's
this is a strange thing, and there's very massive implications here. So yeah, so the QEs would have become utterly inefficient in the resuscitating the economy, and the bigger thing for a central bank is this. So it's the guardian of the commercial banks, and what is now happening effectively is that central bank, we have been hearing reports that commercial banks do not want to hold any larger deposits. And it's because they have become flooded, washed basically with cash. So the basic function of the very essence of the banking system is to hold deposits, and it's going away because of the QE. So the banks are losing their like basic function or the basic mechanism they are there for. And I'm rather certain that this is not what the Fed wants to what Fed wants to happen to banks.
So I heard that they were going to, all this cash, one solution was to not hold it on the bank's balance sheet and have a money market fund that the Fed will back. And that could handle that would handle the problem for depositors, but not necessarily for the banks.
If you think about the money market accounts, they are not like your normal checking accounts. They're very different. You tie the money there basically, and it would just make banks a bigger. They would have a bigger role in the money markets. They would increase their risks and speculative nature of the banks. It doesn't matter if the Fed backs them or not, because it backs basically all the deposits. But it would change the banking system in a very fundamental way. And I'm arguing that the Fed does not want to see this happening. So
what are they going to do?
They're going to taper.
Okay.
By the end of August, probably. Announcement in Jackson Hole.
All right, that's a call.
That's a call.
All right. I don't know if you've been hearing it, but I want to wrap it with this. I think they asked Janet Yellen, who's Secretary of the Treasury now, used to be Fed chairman, about the renomination of Powell at the end of his term, which I think is near year end. And she did not exactly have a ringing endorsement of that, like it's going to happen. And I've heard from other sources like Harold Malgrim that she would prefer Brainerd. So maybe Jay Powell is going to be more concerned about his legacy and that he had to tighten rather than knowing that his tenure may be limited to another 5-6 months. Maybe he does the right thing and tapers.
Yeah, that's
and then he could be blamed for any kind of recession or financial accident and be replaced at the end of his term. What do you think?
I think that's a very plausible hypothesis. Why not? You
always need a scapegoat, right?
Yeah, basically, and it's possible that you don't want to be the one who say, well, you pushed it too far and it went, because there's no exit. There's no exit route for the Fed here. Nothing.
Yeah.
And if you consider the inflation shock on which we warned like in March that it's coming, and now we think it's going to be persistent. So it's going to last and even accelerate. If you add that to it, there is no other option for the Fed than to taper and start to talk about raising rates. And that's not going to go well with the financial markets.
How do you think gold will do and the dollar will do?
I think the gold and the dollar will, at least the gold will jump during the fall. And I'm thinking that possibly also dollar, because it's a safe haven, it behaves really strangely. So in the first stages of a crisis, it will, even if the crisis in the US, it will increase in value or in price.
Okay. So you're due for a prediction to manifest.
I am. Yeah.
You're due, and most of the markets, hearing from different Fed officials, that will be in perfect, the timing will be right to start tapering year end. So this would have a lot of people off sides in August, wouldn't it?
Yeah, it would. And that's our call at the moment, just for the reasons.
Well, you're always worth waiting for, Thomas.
Thank you.
All right. So I'm glad that we're able to put it together and appreciate your view on what's happening here. And you're the messenger and you're bringing us a message. And what they say, in a bear market, anything that could go wrong does. And in a bull market, anything that could go wrong doesn't. So maybe the transition is this August.
Yeah.
And August, I think seasonally is a pretty negative month for the market as well.
It usually is. Yeah. But let's see how this goes.
Okay, and everyone's saying, please come again. So I'm forced to invite you back. I'll talk to you on Twitter.
We will.
All right. All right. So thanks very much for your time. And I appreciate your view on the repo market. And
I'm happy to come back in September to see how our call went.
okay. All right. We'll do that.
Will do.
Okay.
Yeah,
Okay.
thanks.
I'm out to November, but I'll find a day for you in September. Okay.
Excellent. We do that.
All right, MT.
Thanks.
Okay. Thank you everyone for your attendance and sticking around to hear Thomas, and appreciate you guys. You could join Blake and the team in 15 minutes. And remember, don't just count your repo T-bills, 90 days, buy 90-day treasuries and keep rolling them. And I'll see everyone tomorrow. Good hunting, and count your blessings. Find one thing to be grateful for. Adios.